This video is going to introduce Bayes' rule and herding as a justification for why anchoring occurs in finance. So this lecture is all about how we screw up the choices that we make without realizing it. So let's start with reviewing what Homo economicus says about making choices. So basically, Homo economicus is Spock, says that we are all totally rational and we maximize utility with respect to quantity. So we always want more of everything, and that we are considered to be risk averse. But we know already that economists have documented violations of expected utility for many years. So the von Morgenstern preferences attempted to remove psychological assumptions from the theory of decision making. The idea was that individuals had precise information about the consequences of their actions. Individuals had sufficient time and capability to weigh the alternatives, and all decisions were forward-looking. In other words, there was no sunk cost. So game theory came about based on this practice. Utility theory determines how preferences are determined within rational choice theory. So if they're strictly constructed, utility theory assumes a common currency, i.e. utils, to describe different kinds of outcomes. So you saw in our insurance example where we calculated the expected utility with and without insurance. And this is based on the idea that we follow rational choice, so we prefer more to less. And that's where we proved economically that even though you had to pay for an insurance premium, you still had more utility after paying for insurance. So that's the rational side of it. Probabilistic reasoning says that under uncertainty, the value of a choice is the expected value of the probable outcomes, which is what we used when we did those kinds of calculations. So it's all stuff that you're familiar with from economics. Now, this only works in the classroom, but we're going to describe the idea of it. Half of you close your eyes. Okay. When I filled up my car with gas yesterday, the gas was $3.20 a gallon. What is your estimate of average gas prices? Record your answer. And then the other half would do it, and I would say I filled up yesterday with $2.20. What is your estimate of average gas prices? And then I would have you discuss. So this is an experiment relating to anchoring, saying, all right, well, I just gave you a low number or a high number, and you were to ask to figure out the average price based on that. So this actually happened in the U.S. Under George Bush, the average gas price was $1.85 per gallon, so consumers got used to paying less than $2. But under Obama, it crept up to about $3 per gallon, and consumer sentiment was negative. People were pissed. They're like, well, gas prices are getting more and more expensive. I'm not happy. Okay, but then after a few years, that $3 became a new normal. So we began to reset our psychological anchors so that when gas prices started to decline now to about $2.50, we were, basically happy about that. So in one scenario, you are upset about paying $2.50, and in another scenario, you're happy about paying $2.50. So the price was less of a factor than your willingness pay than the context was, right? So it's all about what you expect the price to be. Okay. So how does this work? Anchoring, representativeness, what is it all about? It's the idea that an arbitrary value can impact our decision making, and it happens as a result of an informational shortcut that our mind takes. We can either have a quantitative anchor or a representative anchor. So a quantitative anchor, an example in finance could be a current stock price or recent performance. This could be one of the explanations for why you see support and resistance bounds on there. Prices of other stocks, you know that tech stocks are going up, so you think your tech stock should go up. You don't want to lose money, so we see loss aversion coming in a lot. So that's one of the things we would see where people did not want to invest in the smaller stock, even if it was paying a higher rate of return, right? Because you're afraid of that loss. Representativeness or familiarity can come around from storytelling or just concepts as opposed to specific dollar amounts. So if you hear good things about a company, you tend to think more positively about that company and you expect the stock price is going to go up, that kind of thing. There's also the idea of status quo bias, which is where you just keep doing what you're doing because you've always done it, whether or not that is completely rational. So I'd ask you right now to go and watch this smart person from Yale explain it. So it's a YouTube video where they explain the anchoring bias. Okay, so now you're like, all right, well, I may have fallen for it that one time, but I'll get better at it with practice. So let's try again. Well, what happens is we can test this. They test this in finance. They test this in a whole bunch of different econ studies and psychology studies based on something called Bayesian updating. And you learned about Bayesian updating in your statistics class. The idea of Bayesian updating is that a probability often used to refer to a frequency, but with Bayesian probability, it's a measure of a state of knowledge. So with Bayesian updating, you have previous information that is used to influence your decision. And the question is, how does that impact your decision? And do you update your beliefs appropriately? So with Bayesian updating related to conditional probability. So Bayes' theorem shows the relationship between conditional probability and its inverse. It allows you to make an inference from the probability of a hypothesis about given the evidence of a probability of the hypothesis, given the hypothesis, and vice versa. So that sounds really weird, but this should look kind of familiar. What is the probability of A happening given that B has already happened, right? So that was the conditional probability stuff that you talked about in econ. So what is it equal to? It's equal to the inverse of that, the probability of the inverse, probability of B happening given that A happened, multiplied by the probability of A, and then all of that relative to the probability of B occurring. So this probability A is a prior probability. It represents your knowledge about A before you gather any data. And then the conditional probability, what is the probability of B happening given that A has happened? So it's a function of your knowledge of A. So what is, examples of this? If 2% of the stocks in the S&P 500 had more than a 10% gain last year, what is the probability that a randomly selected stock would have gained more than 10%? So that's an example of this conditional probability. So if your portfolio had 2 stocks, what is the probability that you achieve a 7% rate of return if one of them already returned a 6% rate of return? Again, conditional probability in there. Okay. So here's an example of this in action. This is one that I used to use in my statistics classes. There's a disease present in 0.5% of the population. There's a blood test that is 99% accurate, but has a false positive 5% of the time. That means if someone tests positive, if someone tests positive, what is the probability that they have the disease? So have the disease given that they tested positive. And you can go in here and the probability you see is 9.05%. So in this case, you'd say, well, why even bother to take the test? It has such a high false positive rate. There's only a 9.5% chance that I actually have the disease given that I tested positive for it. I'm going to freak out about it. So this is an example of Bayesian updating. And what we see, is that people don't use this because people don't think mathematically about it. What we actually do is follow the crowd. So we're often influenced by opinions of others. When it comes to stocks, we're influenced by the talking heads on the TV. We're influenced by what they say on Bloomberg. We're influenced by what we see on our websites of choice. And also, if we're following, we're influenced by what the analysts on those stocks say. Now, you could argue that they have more information, so that's rational, but it's not always. Why do we sometimes imitate the choices of others even when we know that, this isn't the right thing to do? Like, why do people smoke? Why do people vape? You know it's going to kill you, and yet you still do it. So this is following the crowd. And so here's the ideas related in finance, following analyst forecasts, looking at news, trading, loss aversion, those kinds of things. Okay, so what is this analogous to in finance? following the crowd. Again, it could be a rational choice to do something. So let's say you're new to a town. You pick a restaurant A in an unfamiliar part of town. You show up at the restaurant and there's nobody there, but there's a lot of people sitting across the street at restaurant B. Maybe they have more information than you, so you go and follow them. You join them at that restaurant. This is called herding or an informational cascade. So the way we see this in finance, hot stock, so a stock, is trading much more often. So you're like, oh, well, somebody must know something about that. It leads to a trend. You assume that they have additional information that you don't have and that they are rationally exercising that information. So you tend to ignore your own information and follow that. The next couple of slides give examples of this. This one's kind of funny. You can go outside and try this. I don't know how well it works in social distancing when you're the only one doing it. But if you go outside and you stare up, you will see that other people around you will also stare up, even if there's nothing up there to attract interest. Everyone wants to know what was that cool thing that you were staring at. So we do see this very often. And I'm going to skip a couple of these. These are about how the process works. So you can go ahead and look at this. This is the probability sections. You can go ahead and look at this on just the PowerPoint slides if you wanted to see the logic of it. Yes, it's all about computing it. Okay, so the general cascade model. How does a cascade form? A group of people make decisions sequentially. So the idea is that you make a choice between accepting or rejecting some previous opinion. You see a fashion trend. Do you decide to follow it? You see a new technology. Do you decide that you need to have it? Analogous to every market everywhere. So you observe a person buying or selling an asset and then make a choice about whether to buy or sell that asset. Does it make sense to do? Okay. And this leads to signals. Now, the idea of signaling is that if there are enough high signals, an informational cascade becomes unavoidable, meaning you will discount your own private information and assume that the information presented by others is better than your information. And then an informational cascade has formed where you discount all of your own information. So this is how herding and anchoring can lead to informational cascades wherein you ignore your own previous information. Now, this is all about the modeling of it, and you can go back and examine this on your own in the PowerPoint slides if you want. But what I want to get at here is the idea that it doesn't matter how many people are involved in this. Once you reach the critical mass of people presenting an idea, you don't follow Bayesian updating anymore. You just go right ahead and say, all right, I will, as long as more than 3 people start to say this, I might just start to completely ignore my own information and just follow that cascade. But what do we need to know about this? Informational cascades can be wrong, right? Accepting the opinion of the masses may be a bad idea. They can also be fragile. Just think right now about Fox News coming out and saying, oh, the COVID-19, it's no worse than the flu. It's going to be fine. And now you don't need to social distance. Everyone should go to work. And now clearly what's happened. So that cascade was fragile. As soon as additional information with a little bit more credibility was presented, the cascade broke. And they reverted and changed direction, and now we're all home. So where do we see this in finance? We see this all the time with bubbles. So if you want to Google my name, you can read a paper I wrote about how this happened with Shemitah. Kind of interesting. You may be interested. I don't care. But that is that. And let's hear your paper presentations.